everybody. Luke Gromen, FFTT. Hope everyone has had a great weekend. Was out at the baseball diamond today after all the storms finally cleared through. We're going to do the two things that grabbed us recently and jump right into it as per usual. The first thing that grabbed us is something I posted on Twitter earlier this week as a follow-up to the Macro Voices All-Star interview we had with Eric Townsend 2 weeks ago on the 13th of May. Eric asked us who has more leverage, the U.S. or China, and our response was that we weren't sure who had more leverage, but the one thing we felt very strongly about was that China had way more leverage than most people thought, and we went on to describe that a potential quote-unquote nuclear option, one that I think is much more realistic and continue to think is much more realistic than selling treasuries or cutting off rare earths, is that the yuan oil contract gives China the ability to set the marginal price of oil lower. Ultimately, if they shift more oil barrels into yuan, then all of a sudden on the margin, because oil is a nearly perfect commodity, setting aside grade differences, the marginal barrel price is the whole. And if the marginal barrel is priced in yuan and yuan's fallen versus the dollar, then the price of oil is going to fall against the dollar as well. And sometimes better lucky than good, I guess, oil has proceeded to fall about 20% in a little over 2 weeks. And so I think that is something that continues to not be well understood around this yuan oil contract. If oil is priced in yuan and dollars, and the marginal barrel price is the whole, then all of a sudden a key driver to U.S. dollar oil prices is not just supply and demand and what's happening to global economic growth, but it's also the yuan dollar cross rate. And so if the yuan's fallen against the dollar, oil's got to fall against the dollar too, unless the United States can sanction every single yuan oil producer in the world out of global oil markets forever. Now, if we look at Iran through that lens, if we look at Venezuela through that lens, if we look at Russia through that lens, suddenly it becomes very enlightening. But ultimately, as they said in Dune, the spice must flow. The spice will flow. And so that is one thing that has grabbed our attention. Is just we voiced this this hypothetical 2-3 weeks ago, and oil has absolutely fallen off the table ever since. The second thing that grabbed our attention has been something we retweeted from Jennifer Ablin at Bloomberg. Barclays now sees Federal Reserve cutting interest rates by 75 basis points later in 2019, starting in September. This to us is really interesting. We came into this year saying that the question for us was, when was the Fed going to begin growing their balance sheet again? We thought it was early 2020 at the latest and probably late 2019. And at that point in time, that was considered crazy. And we're now seeing the Fed being forced to do this. And I think this is also something that is not well understood at all. The Fed's going to have to cut rates not because of necessarily the economy's that bad yet, but because there's a dollar shortage in the U.S.'s own banking system being caused by deficits being too big and foreign bid for treasuries being too small. And so the U.S. government is crowding out the U.S. banking system. It's creating a dollar shortage. You're basically going to have to see these Fed rate cuts and any further dollar liquidity injections coming are effectively going to be the Fed funding the U.S. government. And this, to me, is ultimately something that is not going to be dollar bullish. It's because as long as the dollar's rising, the Fed is basically going to have to keep beating on the dollar until the dollar falls, because the dollar rising is being caused by dollar shortages that have now reached our own shores. So that's the other thing that has really grabbed my attention. So I'm going to run through a couple quick questions here. First off, from Brad Martin, if the dollar suddenly drops in value, as you think may happen, wouldn't the loss in currency value outweigh the return on treasuries? The short version, I want to be careful not saying it'll drop suddenly quickly, but I do think it is likely to get weaker from here. But the crux of your comment, Brad, is exactly right. And that's why there was a Wall Street Journal article over the weekend about an increasing number of foreign private sector investors are beginning to buy treasuries unhedged. You can hedge the FX risk out, but the risk, the price to hedge dollar FX risk has gotten extremely high, so high that actually the FX hedge rates have been negative since October. And to us, there's a very big message being communicated by the FX markets. When insurance gets expensive, when there's a low risk of something happening, insurance is cheap. When there's a high risk of something happening, insurance is expensive. Insurance on dollar falling is getting expensive, and that's the moral of what's happening in FX hedging markets. So I will leave that at that. From Calcium One, thoughts on around a 60% emerging market allocation in Bridgewater portfolio. I have not seen this data point, but I will answer it as if that's the case. So I'm going to take you that's the case. If Bridgewater is actually at 60%, it makes perfect sense. You go back to September, Ray Dalio, the head of Bridgewater, gave an interview on Bloomberg in which he noted a situation that is playing out exactly like he said it would. And the reason we're focused on it is we were saying the exact same thing at the same time, which was U.S. deficits were getting too big, foreign buyers were backing away, and there wasn't going to be enough foreign participation in treasury auctions, and the Fed was going to have to step in some point in the next 2 years. This was 2 years from September, assuming there were no crises anywhere. Of course, 4Q18, we had a bit of a hiccup. And so 2 years probably shrunk in the window. So if Dalio's views parallel with what he was talking about in September, he said, look, the Fed's going to have to step in, finance the government, and the dollar's going to have to fall 30%. And if that's the case, then him buying, putting 60% of his fund into emerging markets makes perfect sense. The last question, real quick, Luke, you got to walk us through the balance sheet analogy where China taking gold delivery pushes down the physical price by removing liabilities. What is on the asset side then? Much appreciated. That's from Freddie. The way to think about that is that think about with Lehman. When creditors showed up at Lehman's door and said, we want more collateral, there was a strong demand for collateral from Lehman. The price of Lehman liabilities or Lehman bonds fell in price because you're removing collateral from a levered banking system. It's basically a bank run is what we're describing. We're talking about the same thing here. Some of it's China, etc. But when too much physical gets pulled out of the bullion banking system, you are talking about a bank run on gold. You are pulling the collateral out from underneath the price we see on our screens of gold is a liability. It is a bullion banking liability. And so the price of liabilities falls. So there's some mechanical reasons why that happens too. A way to think about it is if there's 100 ounces outstanding in paper for every 1 physical ounce and someone takes the physical ounce, the other 99 ounces are worthless or whatever they get cash settled at. So that's a good way to think about it. So I will leave it at that. I'll be in New York later this week recording a solo interview with Real Vision. So I'm excited and looking forward to that. Lastly, if you enjoy these updates, check out Tree Rings on our website, FFTT-LLC.com. It's a nominal subscription fee, 10 most interesting data points, along with a number of different synopses of why we think those are important, some charts, etc. We're getting rave reviews on it. So that's going to do it for tonight. Hope everyone has a great rest of the week, and we will talk to you next Sunday night. Take care, everybody.